The final category of trading strategy that I'll be looking at in relation to best practice stop loss calculations is the trend continuation pattern. Stay tuned. Darwinex is a UK FCA regulated broker and asset manager on a mission to disrupt the financial trading, investing and asset management industries. As a trader, you'll benefit from cost-effective market access via multiple trading platforms and APIs. These enable trading and investing in any US stock, over 60 of the most liquid futures contracts, FX and CFDs. You can even diversify your portfolio by buying and selling other traders' strategies as investable assets themselves. So, if all of that sounds interesting, learn more by clicking on the link top right now or find further links in the description right below. Now back to today's tutorial. Trend continuation patterns are a favourite amongst many traders. Having looked at the basics of this pattern in previous episodes, I now turn my attention specifically to stop-loss strategies in relation to it. I've covered the concept of trend continuation strategies in quite a lot of detail in previous episodes, but the basic premise of this is that you identify a strong trend and then wait for a pullback or a retracement from that trend. And this represents an opportunity that you might want to consider to get into an existing trend if you don't already have a position in it. So we've seen this particular price action before when we've looked at both trading ranges and breakouts. And I'm going to use this trend that started from the breakout of the trading range here. So as you can see, the price came up relatively strongly following the pullback after the breakout here. And then the price pulled back all the way back down to here. So this is that same price action, just expanded a little bit so we can see it more easily. So we have the impulse wave here and the pullback down to here. So let's just take a look at what percentage this represents. So if we draw it from this point here, that was the start of the trend up to this point here, which was the high point. We can see this is almost 50% in terms of the percentage pullback. And so if this was your entry point here, we now need to consider what the logical places are that we could potentially set our stop loss. Many people tend to think that the typical turnaround point following a retracement is between the 38.2 and 61.8 Fibonacci levels. And indeed, these are levels that I used to use as the basis for this myself. However, over time, I've come to rely on the exact Fibonacci levels less and less, and now just tend to prefer to think of the standard range being somewhere between 30% and 60%. And so one place that you might consider setting your stop loss is below that 60% level. So maybe somewhere here. And in a large number of cases, this indeed will act as a good level because the price will very often continue in the trend before hitting this particular level. However, of course, it is still possible to see 80% retracements. But if the price level exceeds 80%, very often it will go to the 100% level. And so again, another good level is just below that 80%, which would be somewhere here. So if the price did break this level, it's probably going to come all the way down to this level of support here at the top of the range. So this gets you out before you suffer those further losses. However, there is an alternative here. This 100% retracement level, which was the previous resistance from the trading range, then became support following these breakout pullbacks, is going to act as strong support again. And so if you want to give your trade a little bit more breathing room before it continues with the trend, then you could also investigate setting this below this 100% level. And this will present much higher support than the 80% level will. So the rationale for these two levels is slightly different. Here, below the 100%, we're relying on this barrier of support to help us. and to keep our position in play, giving it that precious extra time to eventually move into its trend. But here, at the 80% level, it's different. There isn't any line of support here. So the rationale here is that if this level is broken, then the price is probably going to go further, and so it's better to get out now. So two completely different reasons there. And depending on the exact rules of your strategy, depending on the percentage pullback that you're targeting, and also to an extent the assets that you're trading, that will determine whether this level is best or this level. And so there'll need to be some quantitative analysis on your part to come up with a final decision around this. Another consideration here will be the reward to risk ratios that you're attempting to target. So for example, if you're a relatively short-term trader and you're going to be entering the trade on the pullback here with an expectation of exiting after the first leg of that trend, so somewhere about here, then you might consider using a tighter stop loss, so maybe at that 80% level. However, if you're longer term and you're looking to take advantage of a much larger trend here, then it might be a wise thing to give yourself that extra breathing room and set your stop loss below this level of support. So we've now gone through various considerations for three types of strategy: mean reversion, breakout, and trend continuation. In the next episode, I'm going to cover what I call the stop loss dilemma. But why do stop losses pose a dilemma to us? Well, it's because from an account protection point of view, we have to have a stop loss. We don't want those losses to get bigger and bigger with no strategy in place to get out of a position. So on the one hand, we need a stop loss. But on the other hand, stop losses affect the performance of many different types of strategy in a negative way. So for example, if you backtested a strategy without a stop loss, then you add the stop loss in, what you'll notice very often is that the overall performance will degrade. And there's a very good reason why that happens. And it's this that presents the dilemma. We need a stop loss, but it affects the long-term performance of our strategy. So what do we do? Well, I'm going to share with you a technique that I use that's called an emergency stop loss. And this gives us that protection on our account that we need, but produces a less dramatic degradation of performance than a typical stop loss. Now, this won't be appropriate for all types of strategy, but when it is, it can be an excellent addition to your toolbox of techniques to use in your strategies. So be sure to tune into that episode when it's available. If it's already released, then you'll see a link to it top right now. And so until next time, trade safe.